Financial analysis and reporting are foundational pillars in finance, providing critical insights for decision-makers within an organization and external stakeholders such as investors, creditors, and regulators. The primary goal of financial analysis is to evaluate a company's financial health, performance, and future potential by analyzing its financial statements and other related data. Meanwhile, financial reporting ensures that this financial information is accurately communicated to interested parties in a structured and standardized manner. Financial statements are the backbone of financial reporting and analysis, offering a snapshot of a company's financial position, performance, and cash flows over a specific period. For businesses, financial statements serve as essential tools for decision-making, allowing internal management to set strategic goals and external stakeholders, such as investors, creditors, and regulators, to evaluate the company's financial health and prospects. In this lecture, I will focus on the three primary financial statements: the income statement, the balance sheet, and the cash flow statement. Each of these statements provides unique insights into different aspects of a company's operations, and together, they form a comprehensive view of a company's financial performance. The income statement reflects a company's financial performance over a given period, usually a quarter or year. It details the revenues earned and expenses incurred, ultimately showing whether the company made a profit or incurred a loss. Key elements include revenue, sales. This is the total income generated from the sale of goods or services before any expenses are deducted. Cost of goods sold, COGS, the direct costs associated with the production of goods or services sold by the company. Gross profit, revenue minus cost of goods sold, representing the profit before operating expenses. Operating expenses, costs related to running the business, including salaries, rent, utilities, and administrative expenses. Operating profit, EBIT, earnings before interest and taxes, reflecting the company's profitability from operations. Net income, the bottom line, what's left after all expenses, including taxes and interest, have been deducted. It is the company's profit or loss for the period. The income statement provides crucial information about the company's profitability and efficiency in managing expenses relative to its revenues. The balance sheet offers a snapshot of a company's financial position at a specific point in time, detailing what the company owns, assets, what it owes, liabilities, and the shareholders' equity, the difference between assets and liabilities. The balance sheet follows the basic accounting equation. Key components of the balance sheet include assets. These are resources owned by the company that are expected to provide future economic benefits. Assets are typically categorized into current assets, cash, accounts receivable, inventory, and other assets expected to be converted into cash or used within a year. Non-current assets, long-term investments, property, plant, equipment, and intangible assets like patents. Liabilities. These are obligations the company must settle in the future, such as loans, accounts payable, and other debts. Like assets, liabilities are categorized into current liabilities, short-term obligations due within 1 year. Non-current liabilities, long-term obligations such as bonds payable and long-term loans. Shareholders' equity. This represents the owner's claims on the company's assets after liabilities are deducted. It includes common stock, the value of equity shares issued to shareholders. Retained earnings, profits that are reinvested in the company rather than distributed as dividends. The balance sheet provides insights into a company's financial stability, its ability to meet short and long-term obligations, and how effectively it is using its resources. Assets equals liabilities plus shareholders' equity. The cash flow statement tracks the inflows and outflows of cash over a specific period. It helps determine a company's liquidity and ability to generate cash to fund operations, pay debts, and invest in growth. The cash flow statement is divided into 3 sections. Operating activities, cash generated or used by the company's core business operations. It includes cash receipts from sales, cash payments to suppliers, and other operational cash transactions. Investing activities, cash flows related to the purchase and sale of long-term assets, such as property, equipment, or investments. It shows how much the company is investing in its future growth. Financing activities. Cash flows from transactions with shareholders and creditors, including issuing or repurchasing shares, paying dividends, or borrowing, repaying debt. By analyzing the cash flow statement, stakeholders can assess how well the company generates cash from its core operations and how it manages investments and financing.